here. So this is the one that we did so far last time. So we raised capital through equity financing, $350,000, and cash has been recorded as a debit in our pocket close to us, right? And then common stock has no other choice, goes to the credit side. And then we post it to the general ledger, which is at the third page. If you print this, it will be on the third page. If you are working on the Excel, then it will be a little bit down here. General ledger, and that's where the 350 goes. And that's where the common stock goes. And everything is linked, as you see, okay? So the next one we did was purchasing equipment by paying $48,000 cash. And then, of course, we saved it into post it into the general ledger T account. And the results of this accounting equation also was here for you to see. I tried to show you this because this is in your chapter 3. It's showing you something like this. So I want you to get used to it, okay? So all we are doing always in accounting, trying to keep this accounting equation balanced. And you have to do double entry, as you see. And by doing double entry, that means we do a debit and credit. Debit credit means nothing, as I said. It's just a name. And the third one we did, it was a utility expense that we paid for $12,000 for the whole year. So we just recorded in one journal entry. Normally it doesn't happen in one journal entry, it happens in monthly basis, but here we just did it in one journal entry for the whole year, $12,000. And also we have a prepaid rent that we paid in the beginning of the year in order to move into our office. So that rent, since it was not used yet, any of benefit of that office, so it's gonna be just an asset for now. We call it prepaid rent. And if you get an asset, prepaid rent, it goes in our pocket. And cash, another type of asset, goes out of our pocket, far away. So in our pocket is close to us, that's an asset. The other asset goes far away out of our pocket. You're never gonna see it again. So this is now a set of new assets that we have. So we exchange cash goes down. However, the prepaid rent goes up, it's an asset. Why we do this? Because under accrual basis of accounting, we have two types of accounting, cash basis and accrual basis, right? So under accrual basis of accounting, we recognize expense when we get the benefit and we are liable to pay for it. That's the moment you record expense. And you record revenue when you get the job done. You finish the performance obligation. And that's when you record revenue. So under revenue recognition principle in GAAP, we record revenue when the performance obligation has been satisfied and job has been completed and is earned. We call it earned income, revenue, earned revenue. If you get revenue, if you get cash, but you didn't provide any service yet, under GAAP, generally accepted accounting principle, using accrual basis of accounting, the cash that you receive will not be recognized as revenue because it's not earned, and we call it unearned revenue. Unearned revenue, it's a liability. That means, let's say you give me $20 to wash your car. Okay, perfect. I have the $20. Thank you so much. But did I wash your car? Not yet. So I am liable technically to you, right? I cannot, under accrual basis of accounting, I cannot record $20 as revenue yet because I didn't wash your car. So I will record it as unearned revenue. And then hopefully tomorrow or the day after that, I will come and wash your car. The moment washing the car is finished, that moment I will earn that $20 that you gave me, okay? And on the other side, you gave me $20. Did you get any benefit out of it? No. So for you is a prepaid maintenance expense. So that $20 you gave me, it's a prepaid maintenance expense debit for you and cash credit. You see, even for you under accrual basis, that $20 is not expense yet. So look at this number 5. It says in February, one of our customers paid us $65,000. So we received prepayment from a customer for a service to be provided in future. Perfect. We got $65,000. So what do you do with 65? Very easy answer. You put the $65,000 into your pocket close to you, debit. So equals to $65,000 debit in my pocket. Make sense? Close to me. Very easy. The other one needs to be same amount. So equals to that box, enter. But I need a name. Someone gave me money. Did I earn that? Did I do the job? The answer is no, I didn't. So did I earn it? The answer is no, I didn't. So you call it unearned revenue. Unearned revenue. Unearned revenue, it's a liability. Okay? And you wanna click save if it's a QuickBooks, let's say, right? And do another journal entry later on. So here we go, save and new. But this is not a QuickBooks, so you have to understand what QuickBooks is doing. So click on that, just imagine, and technically post it to the T account. Okay, let's post it. Down here. So you got $65,000 equals to, go up, click on that $65,000 debit, click enter, and unearned revenue will be somewhere here. Unearned revenue. The other name for it, you can call it deferred revenue. That means you deferred the recognition of revenue. Unearned revenue, it's a liability. So I'm thinking, what's the, let's say, what is the account number? So let's look at the worksheet I gave you, if I can get an idea. I'm going to just match with this. So unearned revenue here is 213, account number 213. So I'm going to use that. So unearned revenue, it's a liability, starts with 3, and let's use that 213 as a account number. Okay, and this is a little bit too long, so I'm gonna shorten the name. So here we go, unearned revenue, and it's a credit. The normal balance for any liability is credit. Normal balance for any liability is credit. As you see, liability increase if you do credit. Liability increase if you do credit. We call that normal balance for any liability should be credit. So if I tell you, show me a T account that has name is unearned revenue and has $65,000 balance, just by showing me this T account, you should put that $65,000 on the credit side. Why? Because normal balance for any liability is credit. What's the normal balance for any equipment? Any asset, any asset. You see, it's on the debit side. So if I tell you there's an equipment T account, show me $48,000 balance on it, you draw the T account and you put 48 on the debit side. And you have to learn this. How about cash? You have $319,000, let's say. Which side should it be? Normal balance for any asset is on the debit side. How about normal balance for any common stock? It's on the credit side. So if you credit common stock will increase. Normal balance for any common stock is credit side. Prepaid rent is an asset. Normal balance is debit. Asset, debit, asset, debit, asset, debit. How about utility expense? Normal balance for any utility expense is any expense is debit, expense, debit. So since we are talking about this, let's write it down so see if you can remember it. So normal balance here normal balance, okay, normal balance for any, so normal balance for any asset is on the debit side. Normal balance for any asset is debit side. What's the normal balance for any liability? Credit. Liability, credit. Liability, credit. Equity, common stock, credit. Equity, credit. Revenue, credit. Revenue, credit. For dividend, debit. Dividend, debit. Any expense? Debit. So kind of you need to memorize this, but you don't memorize it in one day. It takes about 1 week or two to catch up with this normal balance thing, but it's not a big deal. So asset, billing, normal balance, it's a debit, asset, debit, asset, debit, asset, debit, liability, credit, liability, credit, right? Equity, credit, equity, credit, dividend, debit. Dividend and expense, you see both of them is money going out of pocket, right? So both of them are on debit side, debit, okay? Revenue, you know, revenue is good thing, right? Money comes in, remember something like that, credit. Revenue, credit, revenue, credit, revenue, credit, revenue, credit. So expense debit, revenue credit, dividend debit, equity credit, liability credit, asset debit. Just practice that a few times, you will get used to it. Also, every time we do a T account journal entry, just watch and remind yourself what's going on. So this cash that you received, if you want to put it in the accounting equation, this is how it looks like. So you say equals to, click on that box, enter. So your cash goes up and your liability goes up also in the same time, right? Here is the liability. So equals to that box, enter. So your liability goes up. So now, as you see, both sides are equal. Both sides are equal. So if I grab this, you see there's an equation here on this box. That's the equation. You see that? Huh? So if I grab that equation, grab the fill handle and grab it with your mouse and pull it to the right. There you go. So all of a sudden, all these boxes will follow the same formula in here. The only thing you are saying, don't add up this line, but for this box, add up that line. You see it says J. For this box, add up K line, K column. For that box, L. See L. For this box, M. So I'm just saying, do the same thing, but just change the column and Excel will follow. So that box, the small square over here, we call it fill handle. Just grab it to the right. Grab it with your mouse, take it to the right. Okay, so now if you look, the liability plus equity section equals to assets. Okay, so if I show you, let's say here, equals to that box plus that box plus that box plus that box and plus that, enter. Did I make a mistake? I didn't say plus. This is the desktop that giving me. For desktop, I don't have separate plus sign. I have to keep shift so it understand it's a plus. Anyway, so here we go. Okay. That's the bad thing about this laptop. Okay, here we go. So you see, now this liability plus equity equals to make it everything like $1 and reduce the, here we go. Okay, so far so good. So this 403 and that 403 are equal. So we are doing good bookkeeping, looks like, all right? Accounting is good. Easy, not complicated, just follow specific rules that we are doing. If there is any question, let me know. Other than that, let's do one more. The number 6, it provides me some information. It says the unearned revenue balance at the end of the year is $2,000. That means some of that unearned revenue has been earned already. And where do you get that information from? Normally from the operating management. Because operating management, they are providing services, okay? And they know how much of the service has been provided, and the accountant wants to know what's the service provided, how much is not provided. So at the end of the year, we do some adjusting entries. So this number 6, it's a very good information from the operating management to know what part of the unearned revenue is earned or it's not earned yet. And we will come back to this to do end of the year adjustments. But for now, keep it in mind. Let's go to number 7. In number 7, it says that in December, the board of directors, they declared dividend to shareholders for $22,000 total. So everyone, based on number of shares they have, they get dividend. Like I have portfolio of, let's say, few companies stock, and every quarter I get dividend from most of those stocks. So it will be updated in my portfolio, and I see like few days ago I got $12 or something, or $15 from different companies. So when dividend is declared, that means it's a liability. Of course, they pay not the same day, they pay later on, let's say, but the moment they declare it, it is a liability. So let's record that. So dividend is not an expense, literally, it's just dividend. That's what you call it. It has a different character. So dividend. So dividend will be equals to that $22,000, enter, and something has to be credited. Normally, if it's paid cash same time, you normally say that cash should be credited, right? Imagine, just to make it easy to learn why dividend is debit and the other one is credit. Imagine the other one is paid already. It's just paid. So cash is paid to shareholders as a form of dividend. Cash goes out of pocket far away. Agree? And then obviously the dividend will be debit, and plus normal balance for dividend is what? Normal balance for dividend is debit. You see that? Here, right there. So cash goes out of pocket, and dividend, that's a credit for sure, 100%, swear to God. It goes out of your pocket. You know that already, far away. But something has to be in the debit, and that's the dividend. The other issue is, wait a moment, did I pay already? Here it doesn't say pay, here it says just declared. So if it's declared and is not paid yet, so don't call it cash. So erase cash and just call it whatever it is, dividend, and then call payable. There you go, payable. Simple as that. So it's not a rocket science. So how you do it? One more time. Imagine it's paid. So write it down, dividend and cash credit out of my pocket. But then say, oh, wait a moment, it's not paid yet. So let me erase cash and say whatever it is, let's say utility or dividend or whatever, and then you call it, boom, payable. Dividend payable. Simple as that. And then, of course, you have to click save. That means you have to post it, okay, to where? To the general ledger, right? So let's post it to the general ledger. Since this is not a real QuickBooks, so we have to do it manually. Here we go. So here we say dividend, and we need an account number. Dividend starts with 3. Remember here, dividend starts with 3. Okay. Dividend and common stock, they are in the same category. Starts with 3. But what's the account number? What do you want to use for it? Let's say we have to come up with a number, right? So let's use worksheet to see if there is anything there. Yeah, worksheet says 302, so let's use that. Good enough. So that will be 302. Cool. Dividend 302. Okay, there you go. Now, how much is that? Equals to dividend normal balance debit equals to, right there, that box, debit, enter. The other one is dividend payable, and that's account number. Dividend payable, it's a liability, so you want to start with 2. Do I have anything? Yes, here, 210. Good enough, so I'm going to use 210. Okay, dividend payable 210. Fine. So that's the liability. And that's coming a little bit out of my box. So we say dividend like that, payable, so we can put it in one box. And dividend payable, it's a liability. Normal balance for any liability is credit. So here we go, equals to, and as you see, this dividend payable is on the credit side also. So that's confirmation of our knowledge. And there you go. So your general ledger now is updated. As you see, every single account has a balance. So if I tell you how much cash you have, you look in the general ledger in the cash T account and you tell me that's $319,000 cash we have. And every other account, if I tell you how much money you have, it will show you right there. Okay. And in regards to accounting equation, if you are curious, so it's gonna look like this. So we say dividend, where is that dividend? Here. So dividend will be equals to minus, because dividend has a minus, character. So it will reduce our equity. So dividend equals to that. Enter. Okay. And we have a liability. We didn't pay that, so it's going to be a dividend payable, so-called. So it's a liability. So here we go, equals to liability will increase, and that will be like dividend payable. Enter. So as you see, minus 22 on the right-hand side, plus 22 on the right-hand side, and that will wash it, and still our asset equals to liability plus equity. There you go. Life is good. Make sense? Okay. So this is where it is right now at end of the year, and the dividend is declared. We recognize the liability. We have some other sort of liability here. We call it unearned revenue or deferred revenue because we didn't provide the service yet. And revenue, we don't have it yet. Okay? We don't have it yet. At the end of the year, we need to talk to operating management to see what portion of the jobs that we are doing has been completed so we can recognize revenue. Looks like, let's say this is a type of company that doesn't have immediate revenue and we need to provide service first in order to recognize it. So that's where number 6 comes handy, okay? So now it's end of the year. What you need to prepare at the end of the year, you need to prepare a trial balance first to see how your account balances looks like before you start recognizing any possible adjustment necessary at the end of the year, right? So let's go to worksheet. I can prepare a trial balance separately if I want as a report, but since we have a worksheet and we want to make it a little bit less time consuming, so I prepared the trial balance in the worksheet, and you will see if the both sides are equal or not. So trial balance, it's a report of current balances as of a specific date. So this is, let's say, for December 31st, okay? December 31st of 2014, let's say. So as of this moment, this is the situation that we have. So what is the trial balance? Cash, how much do we have? If you have a QuickBooks, you can get a report of trial balance and print it. But here we have to prepare it ourselves. So here we go. Cash, on the normal balance for cash is a debit. So equals to, go to general ledger. Okay. Go to general ledger and get your cash. Enter. And as you see, your worksheet is showing 319. Do we have any accounts receivable? No. Do we have any supplies? No. Prepaid insurance? No. Oh, prepaid rent. I remember that. We have that. So let's do that. Equals to, go to general ledger, prepaid rent. Yes, right there. Enter. And question, why do, let's say, cash is at the top, prepaid rent is here, and why, let's say, revenue is in here? Because this is like a balance sheet. in chapter 2, you learned classified balance sheet. A classified balance sheet means everything has to be in the right order. So a classified balance sheet, at the top, we have current asset. What is current asset? Anything that can be converted to cash in a matter of a year or less. So cash, accounts receivable, supplies, prepaid insurance, prepaid rent, those are all current asset. And asset starts with 1 anyway. In the classified balance sheet, after current asset, you have investment, any long-term investment, which in this case, we don't have it, so it just doesn't exist. In the classified balance sheet, after investment is PP&E, property, plant, and equipment. So here we go. Property, plant, and equipment are assets that you use in your daily business operation to generate revenue. So if you have equipment as a portion of your business operation to create revenue, this is what the equipment looks like, and it will be in the classified balance sheet in the 3rd category. Number 4 category in the classified balance sheet in the asset section is intangibles. Intangibles are like goodwill, franchise right, patent, copyright, trademark. Those are all intangibles, or assets that you cannot touch it, but they are assets. And they come after PP&E. In this case, we don't have it. Okay. The 5th part of the classified balance sheet, it's other assets, which your book is not that much talking about it. So other assets are assets that you cannot classify in any of those top 4 sections. You cannot classify it in current asset. You cannot classify it in investment, long-term investment. You cannot classify it in, let's say, PP&E, and you cannot classify it in intangible asset. Therefore, you put it in other assets. So that will be something like for now out of this conversation, and we need to continue. So let's go to accounts payable. After assets are done in classified balance sheet, you have 2 types of liabilities you need to show: current liabilities, long-term liabilities. Current liabilities are liabilities that needs to be paid within a year. Long-term liabilities are liabilities that needs to be paid after longer than 1 year. So let's say long-term notes payable. That's a long-term liability. All these accounts payable, interest payable, rent payable, dividend payable, those are all unearned revenue. Those are all current liabilities. Liabilities that needs to be taken care of within a year. After liabilities are done, you go to equity. In the equity, at the minimum, you have common stock and retained earning and dividend. Retained earning here is not showing yet because this is a brand new company, so I don't have retained earning yet. You can put it there, but we don't have it yet. So dividend, definitely I need that. And after equity is done, the revenue, this part, you see that part here? That part is not in the balance sheet. Where is that part then? That part, revenue, and any type of expense will be recorded and reported in the income statement. Okay? In the income statement. So we're gonna learn that later on. So for now, let's see what are our balances. So read chapter 2 for sure, and also follow me in here. So equipment, what do we have? Equals to equipment here, $48,000, enter. Accumulated depreciation, do we have anything? No, because this is the first year of the business and we didn't have any accumulation of depreciation of any equipment that we depreciated. So far, we didn't depreciate anything. So it will be technically 0. Accounts payable, I don't think we have any. Interest payable, I don't think we have any. Rent payable, no. Dividend payable, I remember that. So here we go, equals to dividend payable. Oops, let's go back. No, wrong. Why? Because dividend payable, it's a liability. Make sense? And liability, the normal balance is on the credit side. So dividend payable equals to, go to the credit side, go to dividend payable, which is on the credit side also, and enter. Unearned revenue, I remember that too. So on the credit side, normal balance under liability, and go to general ledger. It's on the credit side also, as you see, and enter. And long-term note payable, we don't have any. Common stock, I remember that. It's on the credit side, normal balance. So equals to common stock on the credit side, normal balance, enter. Dividend, it's on the debit side, normal balance. So equals to, go to dividend on the debit side, enter. Revenue, we don't have any. Depreciation expense, we don't have any. Wage expense, we don't have. Utility expense, I remember. Normal balance for any expense is debit. So go to the debit side, equals to, go to the ledger, and utility expense right there. You see it's on the debit side. There you go. And rent expense, we don't have yet anything. So far, so good. Let's add them up at the bottom. You see I gave you a double line in here already. At the bottom, double line. So let's go there. And here we say sum. So let's go to sum, auto sum. And you see it's just highlighting this area. You can either highlight from top to bottom, or you can grab this fill handle and push it up. Let it go. Okay. So it will be sum of B6 through B31, enter. That will be $437,000. Let's make it a dollar sign, definitely. And let's still not fitting. Let me see if I can increase the size. There you go. Okay, so now we have $437,000 on the debit side, total. But the problem is in the trial balance, your debit side of the total accounts has to be always equals to the credit side of total accounts that you did, just to make sure that you did proper debit and credit. So here we go. Let's go at the bottom and do the same sum over there, or just go back to 437. Whatever formula you made in here, you see that formula? Grab the fill handle, okay? And push it all the way to the right. Voila. You see now all those boxes got a formula. And if you want to increase the size of this, just highlight the top portion and then grab, open it a little bit. And there you go, everything will be adjusted. Okay, so our trial balance is good to go, right? And it's equal on both sides. So it looks like I didn't make any mistake. I did double entry properly. All my debit side balance with equals to all my credit side balance. And I'm very nice and happy at this moment.